Good morning. I'm Tim Schultz, the Director of the Center for Family Business at Cal State Fullerton. As folks are joining us, I wanted to first of all thank you for joining us. This is an interesting topic. Anytime there are changes in rules, it's helpful to know. Family businesses in particular are known for their charitable giving, and so we wanted to share some information about the charitable giving with you from a couple of experts that we have in our own local community. Before we get started, though, I'd like to share with you a little bit of information about the Center for Family Business. We have been around since 1995. We're part of the College of Business and Economics at Cal State Fullerton. We bring together family businesses for community, for learning, thought leadership, and mutual support as family businesses continue on their journeys of legacy and giving. And now, enough with the commercials. I want to get on to the substance of our program this morning. We have two great speakers who are very familiar with the charitable giving space. Margita Labard, Senior Director of Philanthropic Strategy at Orange County Community Foundation, and Dan Whittaker, the Managing Partner for Whittaker CPAs and one of our sponsors. If you have questions throughout the presentation, please put them in the chat, and we will get to as many as we can during this session. So without further ado, Dan, do you want to take it away?
Yeah, that'd be great. Thanks, Tim. I'm really excited to be here today and share information with you guys about some new tax law changes. I know we've all heard about the new One Big Beautiful Bill that was passed back in July. I'm going to move forward here a little bit. So today's changes are really around the changes in tax law related to charitable contributions. So first, let's go over what the pre-OBBBA rules are. And the first thing is for any cash gifts, so just your typical run-of-the-mill donations. Before the bill changes, these were capped at 60% of your adjusted gross income for any taxable year. Any amounts over the 60% were carried forward. For appreciated assets, and what we would normally see here is when clients or taxpayers give stock in closely held corporations or publicly traded stock. It's a 30% cap. So there's so it's not as much of a deduction in a current year. Again, it is carried over or was carried over. Pre-OBBA, there's no AGI reduction in charitable contributions. Clients and taxpayers widely use donor-advised funds, and Margita will get more deeper into this down the road in the presentation. And then from a corporate perspective, corporate giving is capped at 10% of taxable income. And if a corporation gives more than 10%, it's carried over to be able to be used in future years. Now, with any of the conversation we have today around corporate giving, please understand that as corporate giving with the intention of C corporations, because that is deducted at the corporate level versus pass-through entities like LLCs and S corps, where that flows through on a K-1 to the shareholders. So the first change in OBBBA, and we are only going to be focusing on federal changes today. At this point, California has not indicated whether they will or will not conform to any of the OBBBA changes. So today's presentation is only related to federal. From an individual perspective, there is now a floor in your contributions, and it's 0.5% of your AGI. We'll walk through an example of this in a couple of moments here. This is a little bit out of scope on charitable contributions, but it's worth noting. If you're in the 37% individual tax bracket, the tax benefit of your itemized deductions are going to be going down to about 35%. This is something called the PEASE limitation, P-E-A-S-E, and it was in effect prior to the 2017 Tax Cut and Jobs Act. And through that act, it was pretty well taken away. Now we're seeing that come back, and it effectively reduces the benefit of your itemized deductions down to the 35% tax bracket. And I would go into a example in this, but it is a very detailed calculation, probably outside the scope of what we're going to do today. For taxpayers that do not itemize deductions, there is now a $2,000 above the line deduction. And this would be relevant, again, for anybody that doesn't itemize. Kind of where we see that showing up in our client base is older people or older couples who have paid off their houses and don't really have a lot of expenses, so they're not itemizing anymore, or maybe people that don't own their homes. And then from a corporate giving perspective, there's now going to be a 1% floor and a 10% cap or ceiling limitation on how the deductions work. And we'll get into a detailed example of that. All right, so let's go through the impact of the AGI limitation, and let's compare what happens in 2025 and 2026. Let's say, for example, we have a married couple filing joint, and their adjusted gross income is $600,000. They would be in the 35% tax bracket. If they made the charitable contribution in 2025, the tax savings at 35% would be $10,500. Very straightforward. If we make the contribution in 2026, they get the 0.5% haircut. So you can see right there, the second line, AGI haircut, that's simply $600,000 of AGI times 0.5%. So there's a reduction in the charitable contribution. So the tax savings goes down, and it's actually a lost tax savings of about $1,050. So it makes it more beneficial to give that money in 2025 rather than 2026. So let's go through another example of kind of what we're looking at of bunching contributions. If you have income that varies year to year, my suggestion is you do a little deeper planning and start to take deductions in the years that it makes most sense to you, because you're going to get more benefit. So let's say, for example, your income is going to go up significantly. You also are going to have that AGI limitation go up significantly, and it's going to reduce the benefit of your deductions. So there are things that you're going to want to talk to your advisors about and make sure that you plan through this and get the most benefit. If you're in the 37% bracket, consider giving more in 2025 before the AGI reduction and the itemized deduction, the PEAS limitation. And then just for sake of explaining here, in 2025, if you're married filing joint, the 37% tax bracket starts at $751,600. And that is indexed for inflation each year. They have not, IRS has not come out and published what that is for 2026 yet. But just know if you're going to be over, call it $750,000, again, another incentive to go ahead and make contributions this year. All right, let's go through a bunching example. So what happens if we bunch our deductions into a specific year? So in the first example here, we have somebody with $700,000 of AGI. So again, in the 35% bracket, and this compares if they're going to give a gift in 2025 and 2026, spreading 30,000 across each year, versus we're just going to give all 60 in 2025. So you can see in option 1, when we take 30,000 in 25, we get a $10,500 savings. In 26, we have the AGI haircut, and it's a tax savings of $92.75. If you go over into option 2 and you give all of the money in 2025, you're going to end up with about a $1,200 tax savings. So it makes sense if you're giving the same amount every year and you have the cash flow and you have the availability, go ahead and make the contributions in 2025 because it's going to save you a little more in taxes. Let's talk about corporate giving. And again, this is for C Corps, right? So if you are a shareholder in an S Corp or a member or a partner in an LLC or partnership, you're going to get a K1, and your K1 is going to have charitable contributions on it, and that's going to flow through to your individual return. And the scenarios that are going to be relevant to you are the individual scenarios. This scenario here for corporate giving is for C Corps only again. There is a floor and a ceiling, and the first 1% of taxable income is not deductible. Between 1% and 10% of taxable income is deductible. Anything over 10% is carried over for future years. When there's a carry forward of the amount over the ceiling, you also get to carry over the floor. So again, this gets kind of complicated. When the floor isn't met, there is no carryover, and you just have a loss deduction. Carryovers expire in 5 years, and they're used on a first in, first out basis. So this is an example of what that looks like. So again, the floor, any contributions under 1% of corporate taxable income are not deductible. Again, any contribution over 10% are carried forward and available for the next 5 years. If the floor is not met, the deductions are lost. If the ceiling is exceeded, the amount greater than the ceiling plus the floor is carried over to be used in the next 5 years. And then carryovers are used for carryovers can be used for 5 years and are on a first in, first out basis. So here's an example of a C corporation with $5 million in taxable income. 2026, they've got a charitable contribution of $600,000, which equates to about 12% of taxable income. So you can see here in our little graph going across, 1% or $50,000 is the floor. So the first 50,000 of that 600 is not deductible. The next 450, so anything between 1% and 10% is deductible. And then anything over the 10%, over the ceiling, is carried over. Now in this case, because they went over the ceiling, the carryover is the ceiling plus the floor. So their deduction in 2026 is going to be $450,000. And then they get to carry over the 150 to use in future tax years. I hope that makes sense. It's you guys wouldn't believe this, but it's hard to do this graph. It's hard to think through a way to do this graphically that makes a lot of sense without getting too technical. So this is how the corporate deductions work. And then so what does this all mean? This means that comparing to traditional pre-2026, more giving is going to have less deduction. So we're going to want to time our deductions, and we're going to want to plan through deductions and really model this out. This is something that we do with our clients, is we model out what their giving looks like so they can give the right amounts in the years that makes the most sense. Timing matters even more, right? Getting the year right. And then from a corporate perspective, my advice is if you have a C Corp and you guys are giving on a consistent basis, I would act in 2025 and roll your deductions into 2025 if possible. So we got a 3-month countdown between now and December 31st, 92 days. And that means time to get the planning taken care of and get the charities identified. or get a DAF set up and get that taken care of. And from there, I think Annie is taking this over and we're handing it off to Margita to talk about charitable giving.